What is state income tax reciprocity? Have you ever wondered how some people can work in one state but only pay taxes in their home state? This is where state income tax reciprocity comes into play. State income tax reciprocity refers to agreements between states that allow residents who work across state lines to pay income taxes only to their home state. This means if you live in one state and work in another, you won't face double taxation. Instead, you only file taxes in your home state, making tax season a little less stressful. From a conservative viewpoint, these agreements align with the principles of limited government. They respect the authority of states to manage their tax systems without interference from the federal government. By reducing bureaucratic complexity, reciprocity agreements help minimize redundant tax obligations. This approach upholds fiscal federalism, where states work together voluntarily rather than being forced by federal mandates. So, how does this reciprocity actually work? If you are an employee working in a reciprocal state, you simply submit an exemption form to your employer. This form ensures that taxes are withheld only for your home state. For instance, if you are a resident of Maryland working in Pennsylvania, you will only pay taxes to Maryland, thanks to their reciprocity agreement. This process not only avoids the hassle of filing tax returns in both states, but also streamlines payroll for employers. There are two main types of reciprocity agreements. The first is bilateral agreements, which are mutual arrangements between specific states, like Pennsylvania and Maryland. The second type is unilateral agreements, where a state, such as Indiana, automatically exempts non-residents if their home state reciprocates. The practical implications of these agreements are significant. They reduce compliance burdens for both individuals and businesses, which aligns with conservative priorities of minimizing government interference in economic activities across state lines. By removing tax barriers for commuters, reciprocity supports interstate commerce and encourages regional economic collaboration. Republicans often view these agreements as effective state-led solutions that prioritize taxpayer convenience and cooperation between states. By avoiding overlapping tax jurisdictions, reciprocity respects state sovereignty while addressing the practical challenges faced by a mobile workforce. This balance is consistent with the ideals of limited government. In summary, state income tax reciprocity is a beneficial arrangement that simplifies tax obligations for individuals working across state lines while promoting cooperation between states. It reflects a commitment to limited government principles and the 10th Amendment, which reserves powers to the states.